what I say to people now, because there is knowledge, information and training out there, get that knowledge and training at the outset. One way or another, it's going to cost you. It's either going to cost you financially through mistakes or it'll cost you through education.
How to succeed at property development in today's challenging market. To explore that question, I'm joined by my good friend Immanuel Ezekiel. How are you doing?
I'm doing great, thank you, Ranjan. How are you?
Very, very good. Immanuel is a successful property developer, serial entrepreneur, and all-round successful businessman. For the last 30 years, he's completed a number of prestigious property developments in all sorts of different financial climates. And in this video, we're going to talk about exactly the things that you need to consider to make your property development, whether large or small, successful. You probably recognize Immanuel from our previous podcast, which was all about mindset. He's the author of this wonderful book, Wealth Beyond Money. We'll leave a link to that podcast below, where you can find out all about how a successful mindset is key to success in business, success in life, and success in anything. Immanuel, so 30 years of property developing. How did your property development career start? What was your first development project?
So my first development project, proper development project, was actually around the corner from here.
Oh, right.
In London Road, St Albans.
Okay, yes.
It was one of the projects that you like to do. It was an office to residential conversion.
Oh, very good.
And I didn't have much knowledge at the time, and I didn't know how to choose the correct builder. So I did choose a builder, and the way that he stripped out the building wasn't the best.
It still stood up.
So if you can imagine that along London Road, they're all office buildings, which are effectively semi-detached properties. He stripped out the building top to bottom, including the rear, and left just one seal holding them up. At that point, realised we had to get another team in pretty quickly before the other buildings started to collapse in. So we got in a fantastic QS and project manager who shored up the building, and we converted that into 6 flats, which is still there today. It was an amazing project. I learned a lot right at the beginning, including having to dig trenches myself in a suit because the builders didn't turn up, and this concrete was there to make sure some of the foundations were going in. So it was a very steep learning curve, and That made me realise just how much knowledge I didn't have to start developing.
Did it make money?
It did make money. Funny enough, that's because we bought at the right price. We had the right margins, and that's really important.
How
when it comes to
key is buying at the right price?
Buying at the right price is really important. There's 3 fundamental mistakes that most people that get into property development make. The first part is they overestimate or overpay for the value of the property at the outset. The second mistake they do through ego is they overinflate the end value. And the third biggest mistake is they underestimate the build costs. And the build costs are just not the build costs. They come up with many different components, and that's where most people make a mistake. So if you look at those 3 components, if you overpay by 5%, you underestimate the GDV or overestimate the GDV by 5%, and you underestimate the build cost by 5%, your margin is evaporated. So instead of making your 20-25% margin, you make 2 or 3%. And that's where a lot of people fall over by not knowing their numbers.
And of course, in a rising market, people use that to get out of jail.
They do.
2-year project with 10% appreciation each year hasn't turned out too bad, but that's not very good when the music stops, is it?
They say the property market is very forgiving for errors and mistakes in a rising market, and extremely unforgiving in a flat or depressed market. And we have been in a flat or depressed market the last 6 to 12 months, and will probably continue to be so for a little while.
So on your first project then, you made money. You I guess one learning point was how to dig trenches, but what were your big learning points from that baptism of fire?
I had a huge amount of learning on that baptism fire. First and foremost was lending, understanding development finance, which is very different to buy-to-let or normal finance. Second part is having a really good professional team around you. Architects, surveyors, QS, planning consultant, project manager, having the right team in place.
Did you have that on your first project?
I didn't. I stumbled across it by chance because they say you don't know what you don't know. So if you don't know what you don't know, what don't you know? And when you start off in development, especially then, development then wasn't like it is now.
What year was that?
We're talking 20... Where are we now? Probably 1994, something like that.
We start with 19. That was a long time. Now, this is the reason I'm asking that is because your first development was 1994. I mean, it seems like a reasonable scheme. I mean, this was before PD, so that was full planning application, 6 flats. It's quite a reasonable scheme, and to ask yourself all those questions and come up with those answers without the internet, without the resources. And I know back then there's virtually no books on the subject whatsoever. I am fascinated to know how you asked yourself those questions, came up with the right answers on your first project back then.
So, as I said, back then I was a property investor buying buy-to-let vanilla projects, whether it be HMOs or standard buy-to-let. I wanted to venture, which most people think they do. They want to venture into bigger and better things because development are sexy numbers, right? They're much bigger figures at the end of it. So I thought I had the knowledge and the skills to be a developer as opposed to a property investor. The truth was I didn't. I needed the knowledge, the experience. However, I did have the mindset to know that if I navigate, if I use the right questions, I will find the right answers. And that's what happened during the project. So although it didn't start off well, I was able to put a team together to find and help me deliver the project. So it did cost more, but that's a small cost. It's an investment, actually. So when people talk about the professional they have on a project, it's part of the investment and the cost of the project rather than reducing profit. So having the right team is paramount.
See, for a first development, that's quite brave. I think a lot of people may do a back-to-brick HMO or put in a couple of ensuite bathrooms or a loft conversion. But you did 6 flats as your first development. What made you go from vanilla buy-to-let and make that transition into quite a reasonable-sized first property development? It's quite a big jump without a step in between. And that knowledge gap that you said.
Well, I'd done refurbishments before. I'd converted flats from 1 bed to 2 bed, 2 to 3 bed.
Oh, I see, yeah.
I'd split some properties from one house into 3. That was pretty simple. So I thought I had the knowledge and the skills to do something that involved more work. The truth was I didn't. That you don't know what you don't know, and there's a lot that I didn't know at the time. So my learning curve was much higher. So what I say to people now, because there is knowledge and information and training out there, get that knowledge and training at the outset. One way or another, it's going to cost you. It's either going to cost you financially through mistakes or it'll cost you through education. You're much better off getting the education and getting the knowledge rather than making the mistakes on the job.
And as you said before, when the market isn't rising, then it's not forgiving and mistakes are amplified.
Very much so. And when the market's not forgiving, there's a lot of other components that people don't take into account. So when you use finance or development finance and you don't deliver the project on time, the S-curve of borrowing can be catastrophic. So when you borrow at the beginning of a development, your interest is very low. When you come to the end of the project where you've borrowed the most, the interest at the highest. So if you can't refinance or you can't exit, the amount of interest that you're paying, and then you go into default interest, can be quite colossal. So that's why it's really important to know your numbers and not get the education on the job.
And of course, another key factor is, of course, knowing your numbers, buying right, but so much of it can be made or lost through effective project management. Don't get that right, and you're into that default interest.
Yeah, I said your team is so important. Having a project manager that manages the project all the way through, because there's so many different moving parts. So There's different kinds of development. So there's development that's already airtight and watertight. So stuff that you do quite a lot, which I like, which is office to resi, where you've already got the roof on, you've already got the stuff. All you've got to do is internal works. And then you have new build. Now, when you have new build, whether it be houses or flats, you never know what you're going to find when you start digging and having foundations. And that project, depending on your time frame, can be really detrimental if you have to dig deeper, put in more foundations, not only the cost, but the delay in the actual project. So having the team and a project manager manage your trades and the coordinating it is really an essential part of any development.
What's the biggest project, development project you've done?
The biggest project I've done, well, I did two simultaneously. I did two projects, one in Purley, one in Acton at the same time. It was 18 flats combined. GDV was just over about 8.5 million. So that was quite a big project doing simultaneously. In fact, I was actually doing 4 projects at the same time. So the total GDV was about 20 million in total. So that was big, trying to manage all 4 at the same time.
Now, you've been doing developments continuously, and in recent years we've had some choppy waters. There was a time where we've all undertaken projects at the outset with one set of figures, and then building costs and material costs ran away in an unexpected fashion, and also interest rates and finance rates on development projects ran a little bit ahead as well, again ahead of all expectations. How did you cope with that tsunami, if you like, with your projects that were on the go?
So like many developers, we were all faced with similar scenarios at the same time. So one of the things that is really important is understanding development finance and the kind of finance that you have. So a lot of developers on the financial side didn't understand the finance they took at the outset. So having a development product that's a fixed rate of interest, even though it's higher, gives you certainty. The developers that had a fluctuating rate or a tracking rate, when interest rates moved, they moved significantly. And depending where you are in the bill cycle can really damage your effect. So one is your finance. 2 are your numbers. If you don't have enough margin, so most developers, when they evaluate a project, a lot of them look at where the market's likely to be, especially in a rising market. That's really poor formula. So when I do my evaluation, it's always based on current market conditions. And we have a sensitivity analysis. The sensitivity analysis says, what happens if your build costs go up by 5 or 10%? What happens if GDV goes up or down by 5 or 10%? So you have to build that into your cost. So if you don't have your 20, 25% margin, you will struggle when the market conditions change as they did. So we did have that margin. We made a lot less money on those projects, but we had enough margin to weather the storm.
Yes.
So there's 2 rules in property that you always have to follow. Rule number 1 is never lose money. Rule number 2 is always remember rule number 1.
Very, very true. So as you say, a lot of people got caught out. And I think when people look at a finance agreement, they're so happy to get it sometimes, and they just look at the initial terms and they don't read the 20 pages of document that comes with it. And most people missed that because interest rates were static for so long.
I 100% agree. Now, I've been very lucky to have run a very large mortgage brokerage. Also been very lucky to have done a number of projects and developments over time. So reading the terms of a development facility is paramount. So even when people read it, they don't understand what it actually means. And most brokers don't know how to interpret it to their client because the broker just wants to get the deal over the line. And it's not about getting the facility, it's getting access to the money from the facility when you start your project.
That's absolutely true. And I think the thing with the building costs is that was quite unforeseen. They just rose so much in such a short space of time that no one could have seen that. But as you rightly said, the thing that allowed you to survive was having high margins. And there was and particularly when the market gets very excited, a lot of people are so desperate to do a property development deal that they are happy to do things on very low margins.
Yeah, I've never understood that concept. I'd rather leave my money in the bank and not take the risk than put the money and take a low margin. That's a very sure way to commercial suicide. In fact,
yes,
the graveyard is littered with developers who failed based on that concept.
And it's best not to do the deal. We've tried to do a couple of deals ourselves. I mean, one of the deals that we tried to do together was this conversion of this police station in Northwood, and I'll show you a little picture of it here. But just talk us through what our plan was with that.
So we looked at it together. It was a big building.
Oh, yeah.
It had a lot of concrete on the inside, and looking at repurposing a building as well as what was on the external. So we looked at other ways to enhance the value.
Mm-hmm.
We worked the numbers on what we believed would be an achievable scheme. And you and I both came at it a slightly different way. We looked at our numbers slightly differently. And funny enough, we came to very similar end figures coming from different perspective. We set a price that we knew that would make commercial sense.
Yes.
We put an offer based on what that would be. And when somebody else purchased it, they purchased it because the numbers that they needed, what the return that they needed, was very different to what we expected and wanted and needed to have to make it viable for us.
Yes, I mean, we were looking at it on a commercial basis, and the people that got it were looking to build a religious centre backed by money, and it wasn't really a financial thing at all. And you can't really compete against that sort of buyer.
No, you can't compete, but funny enough, even though it's a religious centre, sometimes God doesn't help you get what you want because it's still not built, is it?
Well, it takes heavenly intervention, I think, to get through planning sometimes.
It sure does.
We looked at another scheme in a similar area, a part of a building which was attached to a school. And again, I think with this one, it was a lovely little building, but it was, I think, a time when the market was very heated and there were people happy to do deals with low margins. And we just weren't willing to do that. Yeah,
in fact, that project we liked a lot,
yes,
even more than the police station. Yes. But even though we liked it, we were not emotionally invested.
That's it.
We left the emotion at the back door and relied on the actual figures. And that project could have been fantastic, but the owner, in his infinite wisdom, took too much of the land. They split the title and it made it less viable. And you and I looked at what we could produce on there and the numbers wouldn't work. We were, I wouldn't say we were conservative, we were realistic, and we stuck to our numbers. It's all about the numbers. We left the emotion firmly at the back door.
So I think we both have a similar mindset on this, in terms that if it's not worth doing, we're not going to take on other headaches. You know, why bother? Get a deal with a decent margin, buy it well, and that's a lot of it, really. But you've said no to a lot of deals. Is there one that got away that you really think, in hindsight, should have done this?
Yeah, I'm embarrassed to say about it, but I will. So when I had my mortgage business, I was offered an opportunity through my business partner at the time. They were setting up a company to buy repossessed properties, and we wasn't seeing eye to eye at the time. And they went on to build a company that is accelerating even the current marketplace. They're buying between 20 and 30 properties a month from distressed sellers. I won't say what the company name is, but that is the one that's the whale that got away.
So what's your criteria these days for the current market, 2024? What has to be in place for it to be a good property development deal for you?
So I've taken, as they say, a helicopter view of the current marketplace. Because of the uncertainty still in the finance, the bill cost, the materials, to get the margins that you need, it's making it more difficult.
What margin do you need?
You need a minimum of 25% on GDV, not costs, 25% on GDV, minimum, after finance. So before finance, it's 35%.
Yes. That's what I say normally. Yeah.
That's a bare minimum. So the things that I will look at the moment is distressed developments, where I can come in with my team and finish a development from a developer that didn't know the numbers and pick it up and get it delivered. Most schemes in the current marketplace just aren't working. Vendors, agents that still overpricing the projects and not leaving enough meat on the table. The things that I will look at doing is joint ventures with landowners. Shared risk, shared reward to make the numbers actually stack up. Those are the ones that I will actually look at because they make commercial sense.
The distressed properties that you're buying, unfinished plots and all of that sort of stuff, are you buying them off developers? Is it the developers taking the haircut, or are you buying them off the lender once they're repossessed? So it's the lenders taking a haircut as well?
It's a combination. Because I've been in the industry quite a long time, I'm known as a rescuer to help people. So if the developer comes to me early enough, we can help them deliver the scheme. Sometimes ego gets in the way, they leave it too long, and then the lender comes in or the administrator comes in and they have to take a serious haircut. So my advice is, if you're not able to deliver the project early enough, reach out for help for someone like myself that can help you deliver the project. So yes, those will make numbers and you'll get the margin. In fact, you get a higher margin because of this much higher risk at that point. Things like collateral warranties that you need to be certain that you can get those warranties at the end. So the margin has to be even greater to take on that risk. So quite often the haircuts are quite significant.
Permitted development or planning for you?
Currently, permitted development, no question. The planning system is so archaic, it is so slow, and things that you think should go through, they just don't. So permitted development, without question, if you're going into development, the certainty of getting in and out quickly, no question.
That's what it's all about. What is better for you, an in and out project? Because I think one of the great things about permitted development is you can be in and out in close to a year. With planning permission, it can be 3 or 4 years before you're in and out of a deal. Does that matter to you?
It does now. You need more certainty in the marketplace. The sooner you can get in, the sooner you get out, the more you can plan. So whether it be permitted development or something that has planning, either houses or flats that have planning, so you have more certainty, you get in it straight away. You don't have to wait for planning, because the wait for planning can seriously affect your margins.
Do you find, I find that if I buy something with permissions in place, or if I look at something in permissions in place, that's a lot of the profit gone from the table. I find that a lot of the people that can make those work better are people who have their own building teams. I mean, I find that you can make your money from buying well, from doing a planning gain, building out, and then selling or renting out and all the rest of it. I don't really make my money from building out because I use turnkey builders. That's not my game. So if I can't make my money from planning gain, the whole deal doesn't work. So, but you're not a builder either. So how do you make that work if you're buying stuff with planning, but you're not a builder?
That's a good question. So I'm not a builder like you. I use professionals and teams to come in to do my building for me. So to buy stuff with planning, you have to have the ability to add value, something that's been missed.
Yes.
So here's the thing when it comes to planning. When it comes to planning, most architects design it to get through planning. They often miss the intricacies of how you can add significant additional value by rejigging, whether it be houses or flats, to change the configuration to add more value, more floor space. The more floor space you increase it by, because new developments are priced per square foot, the more you can actually get. So you have to find a way to increase the value or negotiate constructive, creative terms.
Yes. I think you're absolutely correct on that. I think now, for example, the premium attached to a site for planning or with permitted development is much lesser than it was a couple of years ago. And I think also there's plenty of scope for reconfiguring things. But sometimes sometimes the architect has done it from the point of view of sell-on. But if your game is to keep and let out, an optimized floor plate for rental is different for one for sale. So there's simple reconfiguration that can be done to uplift the end value. I mean, that brings me on to my next question. What do you do with these things? Do you sell, do you keep to rent, or both?
I do a combination. So it's much more profitable to build and keep because you pay no tax on debt. So if there's enough margin, you can retain it. So sometimes we sell some, keep some, and sometimes, depending on the project where it is, we'll sell it. If it's not part of our portfolio criteria, we'll sell it. If it is part of our portfolio, ideally we'd like to retain it because that's the easiest way to pay the least amount of tax. So I don't want to pay the government where I don't necessarily have to.
Well, who does, I guess. So your advice for people today, I guess, permitted development, high margins, 35% minimum, make your money when you buy. Let's look at the funding options because you don't really want to use your own money, even if you've got it. But what funding options do you feel, what funding options work best for you?
It's a good question. I have different areas of funding. So I am an angel investor. I'm a joint venture partner. I'm an equity partner. I'm a bridger. So if the deal is right, I will lend money and get the returns. But when it comes to development finance, there are so many different lenders on the market now and understanding what you can actually borrow. So my advice in the current market is to be lowly geared. When you're a rising market, you can take your 80% of costs, 65% of GDV. In the current marketplace, where you don't have the certainty of where the exit's going to be, you want to be really 50% or so you have the ability to refinance and exit where you can and not be held to ransom by the lenders at the end of the actual project. So development finance is really important. And don't focus just on interest rate. Mm-hmm. Focus on the lender that will give you the money when you want to. Again, most developers don't realize that when you get a certificate issued for payment, regardless of whether the lender releases the money or not, you're obligated to pay the builder. And if you don't have those funds, you're in default with the builder very quickly. So having access to the funds to pay on each drawdown is really important.
So when you talk about being lowly geared, you're talking about lowly geared with debt on a development project. So if you don't have all of that equity, then you're basically talking about an equity partner to come in on the deal with you.
Very much so. So, we talk about whether it's your money or not, at some point you're going to run out. So if you have the knowledge, you have the experience, the expertise, but you don't have the finance for a particular project, bringing in an equity partner to help you deliver the project is often a very good way, one, of minimizing the risk, but doing more deals.
Yes, absolutely. And of course, it does more deals, but you don't get caught short if anything changes, particularly in terms of uncertainty. Yeah.
So again, it's not a cost. It's actually part of your business model. So if you can actually have equity partner, you shared risk, shared reward, and you're not governed by a lender pulling the rug under your feet if it doesn't hit what they call their margins or their risk profile. Most lenders, when you go below a certain loan to value, they bring in a covenant, which means you have to top up the development. And most people don't have those extra cash lying around.
Have you dabbled with commercial property?
I have dabbled with commercial property in different sectors. So I still have a building in Hendon where I have the ground floor, which is Domino's Pizzas.
Okay.
And I have a HMO above it, very good covenant, very good rental. I converted a pub not so long ago from a pub to flats above. The bottom I didn't want to keep as a pub, and I came up with a very creative strategy, and it's now a dog cafe.
Really?
Really?
I thought they only had those in Korea.
No, they don't serve dogs, but they look after them.
That's a new business, I guess. Okay, so you've had a very mixed approach to your property career. I know you invest all over the country. You've got clusters of property sort of everywhere and done lots of different strategies. What's your view on sort of diversification as opposed to specialization?
It's a good question. I've often asked myself the same question. So specialization is obviously an area to focus and target on if you can repeat the formula over and over again. However, market conditions change.
Yes.
They change all the time.
Yes.
1 minute development's in, next minute it's not. 1 minute PD's in, next minute it's not. 1 minute to HMO, buy to let. Options. So if you have the knowledge and a toolkit of different property strategies that you can apply depending on the market conditions, it allows you to navigate and to be nimble. It's not always about the top buck. For me, it's about keeping my brain working and being in the market depending on what the market conditions are. And I'll often do 2 or 3 strategies simultaneously.
Give me an example.
Okay, I'll give you an example.
I fully agree with you, and that's what I kind of profess on this channel. Make sure you subscribe, by the way, hit the bell icon. We put out new videos on all this stuff every week. But talk to me about something where you've applied multiple strategies to the same deal.
Yeah, so in the same year, I might do 2 or 3 lease options, whether it be getting a planning gain or buying a property, whether it be a house or a flat, we know a lot of people don't know what options are. So options is the right, but not the obligation. I agree a price today and pay for it in maybe 1, 2, 3, 4 years time. So if it's a development and it's worth, say, 800,000 as it currently is, if I get planning, I might give them £1 million. It might be that I'm buying a house that's worth 400,000 and they have a debt of 400,000. So I will take on the debts on their behalf through an option and agree to purchase it sometime in the future. So it gives me the right, but not the obligation. I then might do a PD scheme, which is office to residential, a pub with uppers if it's got planning already. It might be a new build, whether it be houses or flats, or a HMO or a buy to let, depending where it is, or buying below market value. And there's different ways to buy property if you understand finance. It doesn't have to be your money. So I often talk about, I use a drug. I've been using it for a very long time. You might have heard of opium. And that's other people's money.
Yeah. It's a real shot in the arm.
It's a real shot in the arm. So, a mortgage isn't your money. Equity finance isn't your money. It's not your money. It's how you get access to the money to make the deal work.
Mm-hmm. Yeah, absolutely. And I think it's always important to cost money. And I think one of the mistakes that people with money have is they will say they're buying something all cash, but really they should the cost of that cash. Because otherwise they may be ending up doing a development deal and it's just minimum wage.
Again, when it comes down to understanding finance and money, so people don't often understand cost of money. So I normally explain it. It's normally the interest that they would get on the money. So if they were leaving the money in the bank, it would attract 5, 6, 7, 8, 9, 10%. So that's the money. It's called coupon in our game, the coupon that you would get on your own capital. And if it makes money, then you get part of the equity on top of it. So you have to cost your capital, and most people don't. So when we talk about this 25% or 35% before finance, those are the margins that you need to be able to give yourself a return on your own capital.
Now, this is something I wanted to ask you. Now, you have always been ahead of the curve. So we're here in 2024. What is your crystal ball saying in terms of where you should focus your firepower on property development going forward over the next few years? Where do you see the opportunity?
So for me, property development over the next few years is people that have put in planning application where it's taken 2 years or so and their numbers just do not work anymore. Mm-hmm. They just don't. Mm-hmm. So if you were to put in a planning application 2 years ago, working on bill cost then, finance cost then, you're not going to be able to execute that option.
There's a lot of that out there.
Yeah, I'd say probably 40% of the marketplace that's coming. So I'll give you an example. We were offered last year a scheme subject to planning. We've just been offered the same scheme a year later, a million less than we were offered, and it still doesn't work. So there's lots of people in that have had the cost of planning, and those are the ones that you're going to be able to navigate with the landowner because they know it's not worth any more, to maybe do something on a joint venture basis. We've had a few of those over the last year where people have come up to us with significant value drop because it just doesn't work because of the numbers, interest and bill cost. So those are the ones that I would certainly be focusing on.
I mean, you're right. I mean, and the landowner is basically your equity partner.
Yes.
That's what they're coming into the equation with, and they lack the knowledge.
But they make so much more. That's the beauty.
Absolutely.
So the landowner, normally you pay them a price and they come out the deal. This way, they share the profit and the upside. For you as a developer, your finance costs are dramatically reduced.
Yes.
So first and foremost, you can give them the interest that you would have paid the development finance. That's a huge uplift. So if you've got a development that's costing you 2 million to build and you're paying it over 18 months, you've now got 300,000 more that you can pay the landowner they would have had before. So your finance costs are so much more reduced, and therefore you can also give them part of the actual equity.
And there's all sorts of stuff coming up this year with new PD rights and permitted development rights, which are very, very exciting. And there's always first mover advantage with those sort of things. We saw a site yesterday where it's a commercial building. They've put in planning application, but the planning application hasn't gone anywhere. They haven't made a decision for more than a year and a half. Now, with the new rule changes that we're expecting in just a month's time, this will be permitted development, and you could just secure this and pretty much the floodgates suddenly become open to doing a lot more. And there are so many opportunities like that around planning and PD.
There will be a lot of opportunities for people that recognise the opportunity, called the luck factor.
Yes.
Being prepared is being lucky. Being knowledgeable is being lucky.
So what else? What are the other opportunities for the next couple of years for savvy property developers?
For me, it's helping other developers, investing, helping them support the deals, either as an angel investor, equity partner, bridging loans. Those are the opportunities for people that are really knowledgeable and experienced. Well, for me, certainly my age, I want to have more diversification in the marketplace.
So you talked earlier about it's a great quote about luck there's no such thing as luck, it's preparedness meeting opportunity. What deal have you done? What development deal have you done, which outsiders may think it's lucky, but there's a little bit more to it than that?
I'd say there was 2 deals that I did. So I did a conversion from a nursing home to residential. So when we first looked at it, we looked at doing 5 large flats as a HMO. But when we got the plans and we redrew it, we knew that we could actually get 7 units. So we put in another application. So when we bought it as an option. The option price was 306,000. We paid £1 for the option, and we paid the other side's legal fees £1,000. £1,001 plus our legal fees is what the actual cost was. The planning application was just over 3,000, 3,500. So we're around in about 5,500. Purchase price said was 306,000. We got the planning permission almost immediately for 5 large units, which had been HMOs. We looked at the plans. We knew that was locked in. We then went for a revised application and change it from 5 to 7. That increased the value significantly. We then started the build, and when we went into the build, we noticed there was a huge amount of extra space in the loft, so we created another unit. So we created it from effectively 3 to 8. The GDV on that went from, I think, 1.5 to 2.2. The build cost was 600,000. So we're all in for around about £1 million. So that wasn't a bad deal on an option of £1 and a few thousand on legal fees. So that was a pretty good deal, knowing what we could do with the building because it was an older building.
Now, that's one of those deals which keeps on giving, I guess. And here's a follow-up question for you on that one, is that you often get these projects where there's a little bit more you do, one stage there's a little bit more you can do, there's a little bit more you can do. But sometimes it's best to just stop and exit. And it's different when the bit extra you can do is like on the side plot, because you can exit out of the main building and then work on the side. But if it's like going into the loft, then you can't really exit out of the main building until you've done the loft. So how do you make the decision whether it's actually worth it to push the development a little bit further as opposed to just exit at an earlier stage?
Well, that one was really very easy because it was an area that we had to refurbish in the loft anyway.
Yes.
So while we were doing the build, we put in the application. So while we were in the build, we got the permission within a 12-week period. So it was easy to enhance and do it at the same time. That area had to be refurbished one way or another, either with roof space, joist. So it allowed us to actually do it at the same time. But I do have another deal that was even better than that.
Oh, go on then.
So I was approached to fund a commercial deal, and the commercial deal was to do with storage space. Mm-hmm. I hadn't done storage space before in an area, so I did quite a lot of research. I brought in a couple of people that I do know in the storage space. We put in an application for
container storage type
container
things,
storage, yeah,
yep.
Like the yellow box storage centres. Yes. So we put in an application for 16,000 square feet of this commercial building, and we were just going to sell it on to an operator. So when we put the application in, the council came back and said, we don't want 16,000 square feet. Can you please increase it to 25,000 square feet? So we bought that building and we sold it literally 8 months later or 9 months later. We bought it for $1 million, we sold it for 2.2 million. And all we had was the planning cost. Didn't have to do anything other than just get planning. So that was probably one of the sweetest deals that I've done.
And I think if you keep plugging away, there are ones that get away. But if you keep the strong mindset and you keep in the game and you stick to your figures, then it's amazing how often you will become lucky rather than not doing anything at all.
When you're in the property game or any business, not everyone is a home run.
Yes, absolutely.
There isn't a successful business person that I know that hasn't had a knockback or a failure somewhere along the line, but they learn from it. They use that knowledge and experience to propel them to the next one. So not every deal makes money, some won't, but you use that to help make sure that the next one does. It's not how many ones you lose, it's the ones that you win.
I think do you think expectations among new developers and new property investors have been calibrated in the wrong way? Because if you look at the social media world, people just talk about their home runs.
I think they do. I think people want more honesty, being more realistic. When people come to me, they get honesty. They get all the warts and all, because life is that way. Nothing ever goes in a straight line. Not even your heartbeat goes in a straight line. Things go up and down. The stock market goes up and down. Economies go up and down. In property, you have cycles, and there are different cycles for different strategies. So you have to understand what that is. And sometimes you get caught in the wrong cycle.
Absolutely. And with ups and downs, I mean, we've got a possible change of government coming up. Now, people often say that under a Labour regime, the housing policy is far more geared towards social housing, which favours less developers looking to sell houses or properties to sell on or rent out in the private rented sector. But do you anticipate anything bad or good coming out of a change of government?
I think every government that we've had over the last 12 years or so, there's been some detrimental things for property investors or developers. However, we're a resilient bunch. We see what gets thrown at us and we adapt. We're very adaptive to learn how to make the market work for us. So will there be something? Probably. Can I tell you what it is? I don't know, but there will be a curveball, and the ones that are true professional property investors, developers, entrepreneurs will find a way around it. We always have. And you'll be one of the people I've followed for a very long time.
Well, I always believe, I think one of the things that has always been instrumental to whatever I've done is keeping my ear to the ground, looking at how things are changing, whether it's market changes, tax changes, law changes, legislative changes, and thinking, how can you extract entrepreneurial opportunity from this? And taking that first mover advantage. And if you can do that on a continual basis, then that's really what it's about. And I agree, I don't really know what is going to happen, but I do back myself to be able to figure it out and figure out a way from the set of circumstances that we're all given.
Yeah, listen, they say always do what the opposite do. Avoid what the masses are. People like ourselves will look at the marketplace, we'll adapt, we'll evolve, we'll come up with something that allows us to manage and work within the property market, within the rules, because the rules change all the time. The game is always changing. The rules of the game are always changing. The last few years, the amount of rules that we've seen change. Even now, they're talking about the Leasehold Reform Act in terms of what you can do with ground rents and leasehold. Things are changing all the time. We have to adapt like any other business.
But I always feel that, particularly election year, is a time where a lot of people feel uncertain, and there is a little bit of inertia that will grip the property market around that election time. And that is a tremendous opportunity to get in on some very interesting deals, because just because it's election, it doesn't mean that some people can't avoid selling. They have to sell to get ahead with their life and all the rest of it. Do you buy that?
I do buy that, and I've been saying for the last 6 months, get as liquid as possible as you can, whether it be your money or other. Line up the money, because the opportunities, the deals will be there, and you have to be prepared. If you don't have access to the money when those deals come, the good ones go quickly. You have to be able to move fast.
And it's line up the money, meaning line up the people with the money.
Line up the people with the money, line up your own money. Sometimes you can be your own bank, and we could maybe cover that on another podcast.
Indeed we will. And I think that's pretty much all we got time for on this one. Immanuel, you've been a fantastic guest, loads and loads of insights. Tell me what you think of what we've discussed about property development and the mindset for property development in the comments below. Also subscribe and hit the bell icon. Follow us for more of these podcasts and more tips and strategies to keep you on top of your property investing game. Immanuel, you've been wonderful. Great to have you on board, and we'll have you back for sure on a future podcast. Look forward to it.
Thank you for having me.